Alright, today is Tuesday, March 16th, and this is a post-market recap for the stock market activities today. Ladies and gentlemen, we have entered the calm before the storm period, before the FOMC meeting. Now, there was some jittery trade taking place today. Of course, traders are trying to squeeze every last penny from the trades they have right now before closing and hiding in their shelters, waiting for the storm to pass. And of course, as soon as we get the decision tomorrow, or lack thereof, there will be a lot of movement and a lot of action back and forth depending on how the market will interpret the decision or lack thereof and then react in real time to the press conference from Jerome Powell. The challenge for the Federal Reserve and Jerome Powell is to offer something different to the market, meaning that the previous propaganda tours of denying the problem and saying that inflation isn't really here, and even if it is here, it will be transitory, and even if it gets out of control, we have the tools. Oh, and by the way, yields are rising not due to fears of inflation, but actually due to the quote-unquote good reasons. That bullshit did not work last time for Jerome Powell and the Federal Reserve. They spent over 2 weeks doing the propaganda tour and then coordinating some manipulation efforts with the Australian Central Bank and the ACB, and all of that did not work at all to calm down what's going on in the bonds market. So once again, we are stepping into tomorrow with expectations that if we hear more of the same, then the market will resume reacting the same way it was acting a couple of weeks ago, of selling the Nasdaq, the technology names, the high growth names, high multiple names, and you see yields spiking higher. Now, the $1 million question is, how can Jerome Powell and the Federal Reserve avoid this outcome? What does the market need that is different to tamper down inflation expectations? Before we answer that, the real question is, does the Federal Reserve really have any options left in this matter? That is the real question here. We will discuss the subject and a lot more during the various segments in this show. But for now, I got a market to cover, and here we go. The Dow Industrial Average closing in the red, down by 127.51 points, or a decline of 0.39%. The Nasdaq in the green, slightly, with 11.86 points, or a gain of 0.09%. The S&P 500 in the red, down 6.23 points, or a decline of 0.16%. And what about the sector's performance today? Leading the pack at number 1 and capturing the gold medal, communication services, and at number 2, we have a tie here between technology and utilities, splitting the silver and bronze medal. I don't care how they split them, I got other problems to worry about, because the laggards of the day led by energy, industrials, and consumer cyclicals. So muted activities across the board. We're seeing lots of profit taking from the winners: energy, industrials, materials, financials. Why not? Heading into the FOMC meeting, the risk versus reward assessment says book your profits, and if Jerome does nothing tomorrow, you deploy them back in the market. You buy the dip, because these inflationary names and sectors of the market will continue to outperform if the Federal Reserve does not address the rise in yields and inflation expectations. Likewise, modest buying of the dip in technology and momentum names in anticipation of the FOMC meeting. Some traders are taking positions ahead of time, others are waiting for more clarity. And those traders who bought the dip in technology and growth names, high multiple names, they're betting that the Federal Reserve will do something in tomorrow's meeting, meaning a new policy to control the rise in yields. I doubt it, but this is what they're betting on. Shifting to the futures market performance. For the day, we saw declines for crude oil, modest declines for both the WTI and Brent, down about 1% apiece. What about softs? Lumber, retreating by about 3% today, but the prices remain very elevated. We will talk about lumber prices during the macro coverage in our headlines of the day segment. What about the winners of the day in softs? Led by coffee, OJ and sugar futures. The action in cotton and cocoa futures was muted. Moving on to metals, what's going on here? Sizable declines for copper and silver futures. Meanwhile, we saw gains led by palladium, platinum, and modest gains barely in the green for gold. Lots of nervousness here, lots of profit taking, closing contracts before the FOMC meeting. The storm is coming tomorrow. What about meats? Gains for lean hogs by about 2.5%. Meanwhile, muted action for live and feeder cattle futures. What about grains? Muted activities across the board. And the notable winners here, corn future closing about 1% in the green. Meanwhile, the laggards led by canola futures down just a little over 1%. Moving on to the big casino, the options market. Let's see what's going on here. The action been quiet not just this week, but for about few weeks now. The retail trader disappeared from the options market. They're not gambling anymore. What's going on here? Where did the retail trader go? Are they waiting for more clarity? Did they ran out of ammo? And how would the new stimmy checks factor in? Did the retail trader got whacked already in 2 weeks worth of correction in the market? We will know the answer very soon. We will have clarity after the FOMC meeting, and the stimmy checks will start hitting accounts as soon as tomorrow. But here are the names that led the action in the market today. Leading the pack at number 1, Apple, with about 1.8 million contracts, about 75% of those were calls. At number 2, Tesla, with about 500,000 contracts, about 54.5% of those were calls. And at number 3, Facebook, with about 500,000 contracts, about 69% of those were calls. And moving on to the unusual activities that took place in the options market today. What about the ticker ON for ON Semiconductors? The chip names caught a bid today because we continue to receive news regarding the chip shortage in the automotive industry, and it is causing a lot of delays, a lot of slowdowns, and a lot of backup orders for semiconductor companies. Among them, ON Semiconductor. And in this case, they're making a bullish bet by buying the 43 calls expiration date, April 16th, with expectations that the name will gain over 6% by then. They paid about $1.65 a piece to enter this trade, bringing the total all the way to $4.5 million. And what about the trade for the ticker XLE? This is for the energy ETF, and it is a debit spread. They're buying the 56 calls expiration date May 21st, betting on more upside for the energy sector, specifically for gains of more than 9% by the expiration date of May 21st. And they paid about $1.50 a piece to enter this trade. All in all, bringing the total to about $2 million. But at the same time, they sold the 64 calls, same expiration date, collecting 35 cents a piece from doing so, and that brought the total to about $500,000. So all in all, they're risking $1.5 million for this trade, betting on more upside for the energy ETF. They think that the name, the XLE, can go over 9% gains by May 21st, but not more than 25%. It's a smart structure to make a bullish bet on the energy sector. What about the triple Qs, the NASDAQ? Well, somebody's betting here that more pain to come for the technology sector, because they're buying the 293 puts expiration date April 1st, and this is a bearish bet, expecting the Qs to decline over 7% by then. They paid about $1.25 to enter this trade, bringing the total all the way to $1.5 million. So we have $1.5 million on the line. The Qs will decline by over 9% by the expiration date of April 1st. What about the trade for the ticker SPY, the S&P 500? This time around, they're making a bullish bet by buying the 429 calls expiration date May 21st, with expectations that the SPY will gain over 8% by then. They paid about $1.10 a piece to enter this trade, which brought the total all the way to $1 million. And what about the ticker AAPL? This is for Apple. They're making a bullish bet by buying the 134 calls expiration date April 9th with expectations that Apple will gain over 7% by then. And they paid about $1.25 a piece to enter this trade, which brought the total all the way to $800,000. What about the trade for the ticker TSLA? Tesla at the bottom of the table. Somebody's making a bullish bet here by buying the 820 calls, expiration date March 26, meaning this upcoming week. And they are expecting that Tesla will gain over 21% by then. They paid about $1.60 a piece to enter this trade, bringing the total to about $900,000. Continuing with interesting trades, I want to show you the trade at the bottom of the table for the ticker GME, GameStop. Now, if you do believe that the moves we're seeing in GameStop, sharp move up and down, is due to the retail participation from Wall Street bets or otherwise, you are likely very, very naive, because this is a game being played between hedge funds, pumping and dumping on each other. It's a hedge fund civil war, and the retail trader is the sideshow, because I don't think this bet is coming from retail traders, because somebody's making a bullish bet by buying the 220 calls expiration date this upcoming Friday. They got only 3 days for the trade to work. And they are expecting GameStop to rally over 5.5% by then. They paid about $24 a piece to enter this trade, and that brought the total for this trade to about $8.5 million. Retail traders are now buying options costing $24 a piece, meaning $2,400 per contract. These are hedge funds playing a game. Moving on to the headlines that shape the day, starting with macro news. In the morning, we received the retail sales data, and we were expecting the number to drop by 0.5% month over month. And here is what we got. U.S. retail sales fall as Americans awaited stimulus and harsh weather gripped the South. The Department of Commerce reports retail sales fell 3% in February versus the 0.5% drop expected. Core retail sales fell 3.5%. The January number, this is when we got the stimmy checks, revised to 7.6% increase versus previous reading of 5.3%. Core retail sales up 8.7% in January versus the 6% that we got. Meaning, and here's a tweet I issued today, this is a zombie economy on life support stimulus. Look at retail data in the morning. We will need a new round of stimulus periodically to keep this zombie economy going. Meaning that you see a spike every time we have a stimulus round in retail sales. But once that stimmy is gone and spent, retail sales dropped like a rock. Meaning that people are not spending from their own pockets. They're choosing to save whatever money they make and only spend when they receive free money from the government printed out of thin air. And that is a problem in consumer behavior, that they are choosing to save. They're being very careful here. They're not using credit cards. And this conservative behavior from the consumer will be very alarming to the recovery picture, assuming that that would stick for longer than expected, because the assumption right now is that the moment you open the economy, all of that pent-up demand, all of that savings rate will start splurging and drown the system with a tsunami of economic activity in a velocity of money. But what if the consumer is more conservative? That is a big problem. And here are some of the highlights from the difference between February and January in terms of retail sales. Department stores down 8.4%. They were up 20.6% in January. Sporting goods down 7.5%. E-commerce down 5.4%. Vehicles and parts down 4.2%. Furniture down 3.8%. Eating and drinking down 2.5%. Food and beverage flat. Gas stations up 3.6%. And of course, gas stations are benefiting from the increase in energy prices. So we do have an increase in inflation already, And the splurging tsunami that everybody's anticipating hasn't happened yet. And here it is. The federal government and the Federal Reserve assuming that more money into the system, more stimulus will magically increase economic activity. That is not happening because households are using the money to save or to invest in the stock market instead. Household strength. Net worth as a percentage of disposable income has surged to 754%, while savings rate remains elevated at 20.5%. All-time high for the former, the latter set to surge again with the third round of checks going out right now. So again, more spending by the fiscal and the monetary side in terms of stimulus is not increasing economic activities or output to create jobs and recover the employment picture in the economy. What it's doing is going into bank accounts as savings and in the stock market gambling mania, resulting in a surge of inflation expectations. We're drowning with money. Don't you feel rich? Because according to this study, your disposable personal income surged 754%. So you better feel rich. Money's coming out of your ears, right? Of course, what they're not telling you is that the majority of wealth creation is taking place within the 1 percentile. Survey of investors by Bank of America shows that more than half in each income basket, from less than 30 grand to more than 120 grand, plan to save their third stimmy check. For the lowest income group, substantial portion then goes to food, clothing, and necessities. And ask yourself a question. Is this a good use of fiscal stimulus when we're giving money to people who don't need the money and they're saving it instead? They're not even stimulating the recovery or retail sales, etc. Wouldn't it be better use for that money to create monthly aid instead? For those who need the help, those who lost their jobs due to the pandemic, they're waiting in food lines, they're behind on rent and bills, those are the people who deserve to get the money. But ushering the tsunami of liquidity into the system and expecting inflation not to appear is absolutely delusional. And perhaps you better start saving that stimmy check because your taxes are gonna go higher. Biden wants to raise taxes and collect 2.1 trillion more over the next 10 years. That is 210 billion a year. Last year, the deficit was 3.1 trillion. Why bother? How the hell would we ever get out of this hole? Taxes would have to go up to 90% just to cover this massive hole. Nothing to see here. Federal budget deficit continuing to surge, now at 16.5% of GDP, a record. Once again, how the hell do you think we're gonna cover this massive budget gap? For now, they're saying borrow more money to pay the old debt. That is not a sustainable solution. The budget deficit has become enormous. We're talking about trillions and trillions of dollars. There is no way to even start to close that deficit without raising taxes. You have to be delusional to think that taxes are not going to go higher. What do you think happened to corporate earnings when taxes go higher? Oh, but stocks only go up, right? Stay in denial and keep your head buried deep in your ass. So we got higher taxes coming and higher inflation. How do you think the market's going to perform? Oh, but the supply chain. The supply chain will catch up with all of this demand. And be careful of calling inflation. You have no clue. We have very big and large and powerful deflationary forces. Yada, yada, yada. Here it is. U.S. industrial production unexpectedly plunged in February. Auto manufacturing crashed. The U.S. industrial production month over month for February down 2.2%. The estimate was 0.3%. And the U.S. manufacturing production in February was down by 3.1% month over month. Meanwhile, the estimate was for a gain of 0.2%. A massive disappointment here for industrial production. I know, but these deflationary forces, and you don't have to worry about anything because Papa Jerome got our back, and he's going to manipulate the bonds market via yield curve control, yada, yada, yada. And here is the bond market for you. Today we had the 20-year bond auction, and the high yield went higher to about 2.29%. The bid to cover ratio was slightly better than the previous auction. The direct accepted bids pretty much in line, but once again we're seeing more buying from indirect bidders. Once again, the action from the auction is telling us that the majority of bond investors are waiting for higher yields, assuming that yields are going higher. Because if the recent spike in yields was large enough to attract bond investors to buy the dip and push yields lower, that would indicate that the current surge of yields based on inflation expectations is indeed transitory, and bond investors are taking advantage of the elevated yields, knowing the yields will go lower. This is not what we're seeing here. We're seeing dealers dumping bonds at record levels. We're seeing tamed activities in the recent auctions, suggesting that the investors in the bond market believe that yields will continue to go higher. And what happens when yields go higher? Well, interest rates in the real economy, credit card rates, mortgage rates, they go higher. And this is what we're seeing right now in the housing market. The mortgage rates are going higher and higher, hand in hand with the rise in the 10-year Treasury yield. And now you're seeing that U.S. home builders' sentiment falls to 7-month low on costs. So you have the cost of borrowing from the consumer side surging higher. And then you have the input cost for home builders surging higher and higher by the day. We're talking about lumber, timber, steel, copper, etc. So we're seeing inflation on both sides, on the home builder side and the home buyer. And of course, all of this cost, the inflationary cost from the prices of lumber and other commodities, is being passed to the end customer, meaning us home buyers. And there we have the housing bubble, yet another indicator of a massive inflation building up in the economy. And here's what's going on in yields. The 5-year break-evens are the highest rate since 2008. What else happened in 2008? Here it is. Remember the housing crisis? We have a piece from the Journal today. They're saying that this time, yes, we have a housing bubble, but this time it is different. The pandemic ignited a housing boom, but it is different from the last one. Oh, really? Residential home sales are hitting peaks last seen in 2006, just before the bubble burst. But this time, mortgages are stricter, down payments are higher, and a tight supply is supporting prices. I am just curious. What happens if interest rates continue to climb higher? Oh, but it is different this time around. We'll see. This is probably even bigger than 2008. And all you have to do is to compare the current sentiment and mentality of the current home buyer versus the home buyer back in the bubble of 06 and 07. Well, nothing much changed because home buyers are doing the same dumb mistakes, the same donkey mentality that blew up in their faces back in the last bubble. Now it's happening all over again. In Phoenix, which boasts some of the fastest home price appreciation in the country, Pearl and Andrew Kleinhans saved for 2 years to buy their first home. But even with $200,000 saved for a down payment, they kept losing out last fall in bidding wars with cash buyers. They wanted more space than the 1,200 square foot rental apartment they shared with their 12-year-old son, 2 dogs, and a cat. They wanted to stay in the neighborhood where their son attends school. They started with a budget of $600,000 but ended up having to spend $850,000 in January for a 4-bedroom home. What can you do? Mrs. Kleinhans said it was a bit out of our price range or what I intended to spend, but my husband is a donkey. No, I'm just kidding. She did not say that. What she said is, but that's just what you have to do in order to get your foot in the door. Your foot in the door or your foot in the mouth. I'm not sure. Oh, and what about that COVID thing? You know, the virus that is scaring us and all of that? Well, apparently we're not worried about it anymore. We're assuming that the virus is over, we got the vaccines, we're ready to splurge in the economy, and even professional money managers are now listing inflation as their biggest fear, not COVID-19. But here it is. The World Health Organization saw an 11% spike in coronavirus transmissions worldwide in just the past week. And here is more. AstraZeneca vaccine hold could slow down Asia's economic recovery, says economist. Everybody's stampeding, buying the so-called reopening names, pushing some of those stocks to surpass pre-pandemic highs, even though the earnings, even the outlooks are not matching where the stocks are trading. These stocks should not be trading above their pre-pandemic highs. This is a mania, but everybody's assuming that COVID is over and we're about to have the biggest economic orgy we've ever had. Be careful what you wish for. There is always a possibility of the Black Swan event. Moving on to sentiment news. Where are our stimulus checks, IRS? We want our stimulus now, right now. We're waiting and waiting and waiting like a bunch of zombies high on meth, waiting to storm the gates of the stock market. We want to buy the dip. Amazon can get anything in the world physically to your door in under 48 hours. It takes Uncle Sam 6 days. Americans wait impatiently for their stimulus checks. And here it is, stimulus checks for U.S. individuals, a boon for equities. Proportion of payments online, brokerage account users plan to invest in stock market. And here is by age group. The folks between 25 and 35, they are planning to spend 50% of the stimmy check on call options, gambling. What about by income level? The folks who make over 100 grand will use the money naturally to gamble in the stock market by the tune of over 40%. What about by online investing experience? Folks who have less than or equal to 12 months of experience, meaning the SPAC generation, the zombie generation of investors who invaded the market during the March bottom of last year. Well, those will spend over 40% of the stimulus check in the stock market mania. But rest assured, it is not just the amateurs. Even those with more than 3 years of experience say that they will spend about 35% of the stimulus check in the equities market. So what are we going to buy here? Because we're waiting at the gates and waiting for the stimmy checks so we can blow them up right away. So what are we buying here? What about GameStop? Should we buy GameStop and stick it to the man? Teach all of these evil hedge fund managers a lesson. Wall Street bets, bro. We're the captain of the ship right now. Diamond hands. How about we buy GameStop stock to stick it to the man? Well, here's the man. Bill Gross says he made $10 million betting against GameStop. And this guy indeed is gross. Now, where are we going to deploy the money? We like the stock, we like GameStop, but we don't want to take the risk and we would like to diversify. What about buying an ETF that includes GameStop? What about the Russell small caps, the IWM? GameStop is the largest holding as of right now, so maybe we should buy the IWM instead. Whoops, the price to sales ratio is at all-time highs, reading 169, the highest reading ever, meaning that we are witnessing the biggest bubble in the Russell 2000 index ever in history. But hey, we buy high and we sell low. And who cares if we lose the money? It's not our money, it's the stimmy checks. And if we lose the money, we'll just take a screenshot of our losses on Robinhood. We're gonna brag about them on Reddit and make videos about them on YouTube. Ha ha ha, look at me, I lost $1,400 in an hour. What a genius. Okay, so no GameStop, no IWM. What about SPACs? Should we buy SPACs? Buy the dip, bro? First came SPAC ETFs, then came ETFs to bid against them. 5 months after the first SPAC ETF, the de-SPAC funds are coming. And of course, this is porn to the bears. Alright, so no SPACs. What do we do here? We're zombies. We're high on meth. We got $1,400. We want to buy something, anything. We want to score big. What about new ETFs? How about the new hydrogen ETFs that aims to seize an $11 trillion opportunity? The Defiance ETF CIO says. Let's just pull numbers out of our asses to push the hype higher. But unfortunately for you, this ETF is going to take time to arrive. Alright, so what about we stampede and buy Bitcoin? The 5.9 trillion US ETF industry is racing to win approval for the first Bitcoin fund. But whether regulators will allow it is anyone's guess. Can we stampede on the SPAC that is about to merge with the ETF, or is that too much? What about Dogecoin? Maybe we can buy Dogecoin with the new $1,400 stimmies. And if you thought that this is ridiculous, wait till you hear this. Because the Lord of Soufflés, Reverend Elon Musk, is selling one of his tweets about NFTs as an NFT. And of course, the culties are already stampeding. And here is more in market sentiment news. Inflation, not COVID-19, is now the biggest risk to markets, a Bank of America survey shows. So these geniuses, the so-called experts, quote-unquote experts, are now all of a sudden saying, oh, you're telling us all of that spending, all of that mania we've done last year and we continue to do is going to result in inflation. Well, that is the real virus because COVID-19 was actually the best thing that ever happened to us. But now we have inflation. Oh, we didn't know that last year. We did not know that creating all of this mania will create inflation. Well, now we have to worry about it. And by worrying about it, we're just going to tell our clients not to worry about anything. Otherwise, we will lose all of the fees we collect from them. And of course, look at Jerome Powell in that picture. It looks like a mummy with the deer in the headlights look. He better not look like this tomorrow. Make sure you wear your glasses, Mr. Powell, because that will make you sound smart, even though you're just going to say the same bullshit all over again. But at least you tried. And here it is. Bank of America Global Fund Manager Survey says it is over. The FMS bottom line, investor sentiment unambiguously bullish. COVID-19 no longer number one tail risk for the first time since February of last year. Inflation and taper tantrums now a bigger risk. The V-shaped recovery including a jump in rate expectations, capitulations into cyclicals, and the biggest drop in technology exposure in 15 years. The Bank of America bull versus bear indicator unchanged at bullish with a rating of 7.2. We're talking about a seismic shift here, the comeback of the value investing era. The era of picking a tech stock out of a hat randomly and getting rewarded regardless of which name you pick, or parking your money in the lazy investing practice of ETFs, that is over now. The new market will be a market of stock pickers and growth stocks. And it is not just Bank of America. Here is from Ray Dalio's Bridgewater hedge fund. The world is on the verge of a new inflationary wave that could force the Federal Reserve to raise rates earlier than planned, according to the co-chief investment officer of the world's largest hedge fund. Remember, the market continues to go higher and even thrive during bad economic times. Why is that? It is because, say it with me, the market is a cocaine addict. What is the cocaine for new subscribers? The cocaine is fiscal and monetary liquidity. And the market doesn't care about pandemics, death, destruction, poverty, nuclear wars, asteroids hitting the planet. That doesn't matter for the stock market so long as the printer continues to burr and we see more cocaine flooding the market. Then we can push stocks higher regardless of valuations, regardless of fundamentals. We can base our investment thesis based on future hopes and dreams. But now we have a regime change taking place with inflation rising higher and yields surging higher, reversing 40 years worth of trend. Do you think most market participants will even be ready or see it coming? Of course not. Here is more from Morgan Stanley, talking about the note from Bridgewater. Coincides with Morgan Stanley's note this morning, which reads in part, "We think a transition to more restrictive monetary policy in response to rising inflation may come sooner than many anticipate." Meaning that now that yields are rising higher, guess what's going to happen? The flow of cocaine will get interrupted because the Federal Reserve will create massive inflation if they don't cut rates. And when the Federal Reserve cut rates, the cocaine operation will come to a halt. And the market, the cocaine addict that it is, will suffer a withdrawal and will crash in a severe manner. And this is why I keep saying this market will thrive under a bad economy, but will get completely destroyed under a good economy. Bad news are good news. Good news or bad news. Welcome to the freak show we call the stock market. You thought it was easy, didn't you? You just open a Robinhood account, you buy the stocks that you like and you recognize, and you watch these stocks going higher and higher every day. It's like a video game. Well, those days are coming to an end, baby. And here is the last bit in sentiment news. Hedge funds sold $49 billion of U.S. Treasuries in January, the most in 9 months, and a sign of the growing bet on higher inflation and growth. We're talking about growth in the economy, which is not good in the stock market, at least in the technology sector. But we know that the technology sector and the high valuation names happen to be the largest component in the market. So money right now is chasing the lagging sectors, the sectors that would benefit under high inflation. Financials, energy, industrials, materials, but even these names are getting pricey by the day. And as I told you before, it is a game of Tetris. You're gonna continue to weasel your way around, finding gaps to fill and extending the game over and over and over again. But sooner or later, you're gonna face the inevitable. The stock will get so high, the reinflation names, the reopening names, tech stocks, everything will become overvalued, overbought, and then you reach game over. The stock market is prime for a reset. Moving on to corporate specific news, starting with Pfizer. Pfizer executives say there is a significant opportunity to hike prices for its COVID-19 vaccine. Why not? After all, it is the golden age for crime. But if the crime comes from you and me, we got a problem here. Even if it is a minor crime, such as sharing your Netflix password with other people, you can't do that anymore because Netflix is coming for you. Netflix is reportedly taking a firmer stance against people sharing account passwords, which could drive new subscriptions but also alienate some customers. And what about Visa? Visa is delaying a planned increase in merchant fees until April 2022. Oh, how generous of them. But once again, they will have the power to increase merchant rates. Of course, those increases in costs for the merchants will be passed all the way to the end customers, meaning us. So we will be paying more and therefore more and more inflation. And in my inflationary trade stocks, I recommend buying MasterCard and American Express because all of these credit services, including Visa, will benefit tremendously from higher inflation. They can charge more and get away with it. They can pass it to the merchant, and the merchant will pass it all the way to me and you. The end customer will bear the bulk of the pain in this inflation. What about Alibaba and Jack Ma, China? What is going on over there? China is adamant that it keep control over information and propaganda. So Jack Ma's company must sell its media assets and spend its cash elsewhere. I told you don't buy the dip in Alibaba because this movie is not over. Certain donkeys did not listen. They bought anyways, and now we have more trouble with Alibaba. Here is more. Alibaba's browser has reportedly been deleted from Chinese app stores. So they're bringing down the hammer on Alibaba. We're talking about the Chinese regulators, of course. That would not be good for Baba investors. Here is more from China. This time regarding Apple. Chinese tech companies, including ByteDance and Tencent, are testing a tool to bypass Apple's privacy rules and track iPhone users without their consent to serve them targeted advertisements. And if that actually happens, then watch out for the iMob because they will start panicking and scrambling around trying to preserve their monopoly. And what about Foxconn? Foxconn. Get it? Says it might build EVs at empty Wisconsin site or in Mexico. And I kind of have an idea already on which side they will pick. Moving on to the souffle. It wouldn't be an awesome nightly show without our daily dose of the souffle news, wouldn't it? So here it is. The NHTSA investigating violent Tesla crash. Autopilot not ruled. More trouble for the souffle. The National Highway Traffic Safety Administration said Monday it is investigating a violent crash on March 11th that involved a Tesla sedan and a semi-truck. The NHTSA has previously embarked on probes into more than a dozen crashes that were thought to involve Tesla's advanced driver assist systems, but has not yet determined if these systems were engaged in this crash. Another federal vehicle safety watchdog that gives recommendations to NHTSA, the National Transportation Safety Board, recently called for clear and stringent rules for automated driving systems at a federal level. Here is more bad news news for the souffle. VW CEO says he wants to get close and then overtake Tesla. But the problem for VW and other car manufacturers is the following. VW CEO unable to build 100,000 cars due to chip shortage this year will not be able to compensate for it. How do you exploit this whole chip shortage phenomena that is going on right now? Certain investors and traders will buy semiconductor names directly. The problem is that most of these names already rallied higher under the assumption of an upcoming chip shortage. The way I'm playing it is betting on the rise of used car sales, because as less and less new cars hit the market due to the chip shortage, the value of used cars will surge higher. Who will benefit from the sales of used cars? CarMax, and therefore I bought CarMax stock. But there are many ways to exploit what's going on in the market. In this case, the chip shortage phenomenon. Moving on to the heat map analysis, and let's see what happened today. Right away, the sell-off in the inflationary names actually intensified from yesterday. We saw financials down, energy down. This time around, industrials also joined the downside along with materials. Certain names such as Freeport-McMoRan down over 5%. Names in industrials such as Caterpillar down almost 2%. Honeywell down almost 2%. Boeing down almost 4% today. And of course in energy, losses across the board. Exxon, Chevron down about 2% apiece. Likewise in banks, JP Morgan down over 1%. What is working today? It is not the high valuation mania names. And I think the market is making a very important distinguish here between, say, the big technology names, even the more fairly valued names within the technology sector, and the mania names. For example, Tesla was down over 4% today. NIO was down. Zillow was down. Zoom was down over 4%. Peloton down over 4%. Snowflake down over 2%. DocuSign almost 4%. Square down over 3%. Palantir down over 4%. Meanwhile, Apple closing in the green, Microsoft in the green, Facebook, Google, Amazon, the semiconductor names, specifically the value ones, Intel, Micron, Qualcomm, they managed to close in the green. What does that tell you? It tells you that this is a valuation phenomenon. Yes, we're seeing profit taking from the hot names of the inflationary trade in energy, industrials, financials, etc. But this is only profit taking in anticipation of the FOMC meeting. If we don't get anything new, then this will be a dip to buy in these names. But the market is distinguishing between the mania names and other tech names. They might be overvalued by traditional standards, but once again, you cannot compare Google with Zoom, for example, or Snowflake with Facebook. One is slightly overvalued, the other is in mania territory. And what's going on with the themes in the market? Starting with the nostalgia stocks, the reopening stocks. Let's see what's going on here. We are seeing profit taking here in the reopening names. We talked about some of these names trading in ridiculous territory, surpassing the pre-pandemic highs, and it is time for a haircut. Well, today they got the haircut, profit taking before the FOMC meeting. And what about the inflationary trade? Similar story here. We have some modest gains in names like Newmount, Mondelez, United Health, but the picture is clear. We saw profit taking here in some of these names in anticipation of the FOMC meeting. They could refill these positions once again, depending on the outcome from the meeting. And what about the deflationary trade? What's going on here? We see a similar story here with profit taking before the FOMC meeting. We saw gains, sizable gains since the rebound that started last week in some of these names. And now you're seeing investors taking profits or perhaps cutting losses in anticipation of the meeting. So wait a minute here. The reopening names were down. The inflationary stocks were down. And the deflationary stocks were down. So how the hell did the market manage to close in the green? We're talking about the Nasdaq. The reason is the outperformance from big technology names. This is the ETFization effect of the market. The weighting of Apple, Amazon, Google, Facebook, Microsoft all managed to outperform today, and that led the Nasdaq to close in the green. Whether that's going to continue tomorrow or not, that's a different story. But I find it very interesting that the market today managed to distinguish between names like Microsoft, Apple, Facebook, and names like Snowflake, DoorDash, DocuSign, the mania names. Because, like I said before, the big technology names, yes, overvalued, specifically by historical standards, but the majority of the mania is in smaller names within the technology sector. Moving on to the charts analysis, and let's see what's going on here. Starting with the SPY 15 minutes chart. What's going on here? Anything different? Absolutely not. We made yet another higher low, and the series of higher lows will continue to go on until and unless we spot a reversal. Now, don't get me wrong, we are seeing a plateauing of the move, meaning that the bulk of the gains are already here, and now we are susceptible of breaking this trend. Moving on to the daily chart of the continuous contract of the SPY, once again failing to crack above the resistance of 3,960, which happens to be the all-time highs. We closed at 3,952.5. Now, overnight, you might surpass that number, but once again, what counts is at the end of the day, can you close the day above 3,960? If not, then we're about to face a lot of trouble here, because the SPY has every tailwind intact right now to break above all-time highs. We're talking about the futures contract, the continuous contract of the SPY, and yet it is struggling. Furthermore, the sell-off in the cyclical names such as energy, industrials, financials, materials, that is starting to impact the SPY. We were wondering, everybody was asking me, how come the SPY is not going down where Apple is down and Tesla's down? Well, the S&P 500 has more components to it than the high technology, high mania names, and therefore it continued to go higher and higher and higher due to the outperformance of the cyclical sectors of the S&P 500. If the outcome of the FOMC meeting result in more sell-off and profit-taking in, say, energy, industrials, financials, then we will see that the S&P 500 will trade lower. Moving on to the Qs, 15 minutes chart. What do we see here? Remember, I told you before that 313 is the center of gravity. And last time around, we gapped above 313. I told you, you will have to go back and revisit 313 and pay Mrs. 313 the respect she deserves before you are allowed to go higher. Now, here's a story for you. Mrs. 313 happens to be a very possessive and jealous lady. And when the triple Qs, the naughty boy that he is, just ignored Mrs. 313 went higher like she doesn't even exist. She got mad, she pulled him back. Wait a minute, sit down, have a cup of coffee, let's talk, pay me the respect that I deserve, and then you have my permission to travel higher. The problem is that Mr. Triple Q's is a dirty one, and he managed to go all the way upstairs, knocking at the door of Mrs. 323, which I identified on my Twitter account as the next resistance today. Now, here's the problem. Mr. Triple Q's got caught by Mrs. 313, and she is very jealous, very possessive, and very angry. And Mr. Q's has two choices. Number one, to run away as fast as he can, higher and higher and higher, by gapping higher overnight, going as far away as he can from Mrs. 313. Because if Mr. Q's doesn't, then there is the next choice, which is going back to Mrs. 313, apologize, and try to sort things out. The problem is, from my perspective, that if Mr. Q's go down to Mrs. 313, and apologize, that would be a mistake, because Mrs. 313 is setting a massive trap for Mr. Q's. If he decides to come down and apologize, she will take revenge, sending him lower. Enough said. What about the daily perspective? The continuous contract of the Nasdaq. What do we see here? I told you that my target here for the rebound is to go all the way to retrace the purple trend line, and that would be a resistance. And this is exactly what you're seeing. Today, we managed to go all the way to the purple trend line, but we closed below the highs of the day. Not a big deal, but it has to be followed by another attempt tomorrow. If you reverse tomorrow trading in the red, that is your reversal confirmation. And we will see lower prices in the Nasdaq indeed. How low, you might ask? Well, let's take a look at the NDX and do a Fibonacci retracement analysis. We are struggling here at the Fibonacci level of 13,276. It looks like a bad closing, and if we dip down in the lower Fibonacci level, under 13,100. That would be a problem for the NDX, the Nasdaq, and that would signal the reversal. Here is another way to look at it from a weekly perspective, the NDX. Are we seeing a bear flag formation that is supposed to take us lower? That is indeed what I'm seeing, and that would not be negated until you close the gap that you see right after the first candle of the bear flag. Moving on to the IWM, what do we see here from a 15 minutes perspective? A big down day for the IWM, lagging other indices, and if you do believe the theory that the Russell 2000, the IWM in this case, is a predictor for the next move of other indices, some technicians believe in that theory. And if you do subscribe to that theory, then this means that we will see declines in the SPY, the Qs, the Dow Jones, and the leading indicator in this case is the IWM. But as I told you, this has become a meme ETF, and it is becoming extremely alarming and dangerous because the weighting of this ETF has changed dramatically, and the biggest holding right now is GameStop. If GameStop crashes again, you will see a lot of pain in the IWM, but it remains unpredictable here from a daily perspective, because you cannot make a conclusion that the action that we saw today is a reversal candle. And the reason is you have no clue what will happen to GameStop stock tomorrow. This has become once again a meme ETF. But from a candle's perspective alone, what we saw today is indeed a reversal candle. We should expect lower prices in the IWM. Moving on to the Dixie, the dollar index. What do we see here? Once again, struggling to break above 92. But as long as the consolidation and the struggle to break above the level is happening very near it, and in this case, you see that the dollar index is consolidating right below 92, another signal that the break could go higher. It's just a matter of time before closing above 92. But remember, as everything that we discussed today, it is dependent on the outcome of the FOMC meeting. Everybody's waiting and waiting for more clarity. And decisions, big decisions that is, will not be made until the aftermath of the FOMC meeting. Here's another chart waiting desperately for the outcome of the FOMC meeting. Gold. I see a bullish flag formation here that is supposed to take us all the way to 1765. Now remember, the dollar index and yields are dictating the outcome of gold, and gold is being more sensitive these days to yields more than it is sensitive to the dollar. So once again, if for whatever reason yields start to trade lower after the conference, then you will see gold trading higher, regardless of what the US dollar does, unless it is a very large spike higher. Then gold will struggle to rally. So gold, just like the Federal Reserve, is between a rock and a hard place. It's becoming extremely difficult for gold to rally. What about Bitcoin? We saw a massive drop yesterday. But that was not a cause for alarm, at least for me, because we are still marking a series of higher highs and higher lows. Until that is negated, Bitcoin will go higher. We don't have any reversal candle whatsoever. If anything, we have a reversal candle that is telling us higher prices are here to come for Bitcoin. And what about yields? We are in a series of bull flags formations all over the place. And here we are again. We are seeing a bull flag formation in yields that is supposed to take us higher. Once again, it all depends on the outcome of the conference. But the technicals alone are saying higher prices, or higher readings in this case, for the 10-year Treasury yield. How high, you might ask? Let's take a look at the actual chart of the 10-year Treasury yield. Here's a weekly chart, and we are doing Fibonacci retracement to see how high yields can go. And there is a lot of room to rally here. a lot of room for an explosion higher in yields, and that could take us all the way to 1.9%, very close to 2%. And if 1.5% was not enough to freak out the market, watch what happens if we go all the way to 2%. That could happen within weeks, by the way. We're not talking months from here. It could happen within weeks if the Federal Reserve fails to deliver once again. Moving on to the VIX, what do we see here? Closing below 20. The traditional way to look at this is the VIX is closing below 20 for the first time in a very long time. This is a signal that a massive bull rally is about to happen. But I'm not a fool. I don't read it this way. I told you the moment the VIX will drop below 20, I will be a buyer of volatility. And the reason is you want insurance in your portfolio when the volatility index is lower. You could do that by buying VIX proxies, or you can buy puts on the SPY. The way I did it this time around, I did not buy the VXX or the UVXY. I bought straight out puts on the SPY, assuming that the VIX will start trading higher from this point on, which will also mean that I am betting on a market sell-off tomorrow. Either way, either the Nasdaq will drop down big if Jerome Powell doesn't do anything and we see yields rising higher significantly once again, or we will see the cyclical trade of energy, financials, etc. being sold off severely due to a decision or a manipulation from the Federal Reserve that resulted in yields trading lower. Either way, to me, the risk versus reward was on the side of going long the VIX at these levels. And what about Apple? 15 minutes perspective. You saw the Qs struggling throughout the day, going back and forth, because a lot of traders are closing positions before the meeting. But I always say, as Apple go, so will the Nasdaq. And Apple managed to close in the green. So did the Nasdaq eventually, even though you saw massive declines in names like Tesla and the likes. But from Apple's perspective, it managed to do the job. It closed above 125. So Apple is saying, hey, Mr. Qs, you better get your shit together with Mrs. 313 because I am doing my part here to push you higher. I managed to close above 125. What more do you need? So Apple did the deed, managed to close above 125. What about the other large component of the Nasdaq, Tesla? Did Tesla deliver? Absolutely not. Tesla's number was 700, and Tesla went back and forth throughout the day, struggling to keep 700 as support. And once dipping below it, it tried to knock over and over again to break above it. That did not happen, and we saw a harsh rejection here for Tesla from the level of 700. That is not good. That is an indicator that lower prices are to come for Tesla. So the only thing keeping the Qs intact right now is the performance of big technology, specifically from Apple. If Apple drops tomorrow morning, that would be a big problem and a sign of trouble for the Nasdaq. What about the daily chart of Tesla? Let's see how low can we go here from a Fibonacci retracement perspective. We closed at 676.88, and the Fibonacci level here is 679.44. Very close. We're not going to make a big deal out of it because the numbers will change depending on how you adjust the drawings. But here is the ultimatum. Tesla is not allowed to break 679 once again. You gotta trade above 679 tomorrow, by tomorrow, for me to realize that this is just a bull flag consolidation that would take Tesla higher. If you dip below 679, then you're pretty much negating the bull flag formation, and there are lower prices for Tesla. A lot lower. So we're keeping an eye on Tesla tomorrow. Moving on to conclude this video. What do we have tomorrow? Just in case you are asleep throughout this video, we have the big day, the Fed's day, the most anticipated day. We've been waiting for weeks now for this moment. The FOMC meeting, the decision, and the conference. Here is the struggle for the Federal Reserve. What do you do now? Are there any options left for them? Because either they're going to implement yield curve control measures by announcing Operation Twist or other forms of yield curve manipulation. The question is, how would the market respond to that? On paper, that is very good for the market because the bulk of the concerns are around the rise in Treasury yields that is diluting the present value of future earnings in the technology and the growth sector. The problem is the market might interpret that very differently. It might interpret it as that the Federal Reserve is finally waving the flag and admitting indirectly that the inflation problem is serious and it will get out of hand, meaning that whatever manipulation the Fed is going to do, that will be just temporary before the bond vigilantes push yields higher again. Likewise, admitting the existence of inflation and the trajectory higher for inflation means that the Federal Reserve is hinting to the market that the cocaine operation, the bond purchasing program, will come to an end. If you are admitting that inflation is a problem by manipulating the yield curve, then you're also saying that the cocaine operation of liquidity will come to an end sooner than expected, meaning that the market will throw a fit either way. It's a lose-lose situation. So what is the obvious choice here if you are Jerome Powell? More of the same. But Jerome Powell will be more assertive this time around, maybe more specific. You know the dumb shit that Jerome Powell is going to do. He's going to use the word powerful. He's going to use the word our tools. We got a lot of tools. We have a lot of options. Aggressive. All of these buzzwords just to try to manipulate the yield curve lower, by trying to convince the market that everything is under control and the market is just throwing a fit and overreacting. And even if things get out of control, inflation-wise, we got the tools to deal with it, baby. Remember tool man Jerome with his tools? Well, Jerome is the tool because the market rejected this message before. So if he goes out tomorrow and performs the same dance yet again, yields will explode higher. And the inflationary trade, this is the assumption, will start to outperform once again. Meanwhile, growth, technology will start to plummet. This is at least my take. I don't know what your take is. You can write me in the comments and tell me what you think. But Jerome Powell has no choices here. This is the only choice, to cross your fingers and hope that the propaganda this time around, third time is a charm, it will work and it will push yields lower, because otherwise there are no choices. If you enact a specific policy of yield curve control, that will be misinterpreted and the market will throw an even bigger fit. So my take is Jerome will do nothing. He will continue to do the same propaganda, the same dance. He will talk for an hour or so during the conference, nothing but gibberish, bland questions about climate change and racial inequality, yada, yada, yada. So what is my strategy here? My strategy is the following. If we do see yields surging higher on the aftermath of the decision, then I will sell calls in my bank holdings, my financial holdings. I have Goldman Sachs and I have US Bank. I will sell upside calls for these names, assuming, of course, that financials will rally higher if we see a spike in rates. Now, if the second outcome takes place, where we see yields driving lower and technology and mania names surging higher, I do have some calls open in these names, Neo, Snapchat, etc. These will appreciate. So I have a strategy to play both outcomes. Here is the third outcome. I'm not trying to confuse you. I'm just trying to explain to you the different outcomes that the market could face. We talked about the scenario of yields rising higher, and as expected, the inflationary trade goes up and the deflationary trade of tech and momentum dives lower. The other outcome is, whatever reason, whatever decision that happens in the aftermath of the meeting will drive yields lower, and we will see the Nasdaq, the mania names surging higher. Meanwhile, energy, financials, the inflationary trade diving lower. These are the two scenarios, the obvious ones. But what if I told you that there could be a third outcome? And that outcome will happen if we see a massive surge in yields that happens suddenly after the meeting, meaning that the 10-year Treasury yield skyrockets higher to north of 1.7. So let's say we get to 1.8, 1.9. If that happens, the entire market will start to freak out and we will see a sell-off across the board. The inflationary trade, deflationary trade, technology, momentum, growth, value, all of them will get slaughtered if we spike significantly higher. I'm just giving you the scenarios out there and how I'm playing them. I'd love to hear from you on what you think the outcome would be. And more importantly, what do you think that Jerome Powell and the Federal Reserve should do to address the rise in Treasury yields and the rise of inflation expectations? Do they have any options left? Let me know in the comments. Anyways, that's all I got for you tonight. I'll talk to you again tomorrow. If you found the information presented in this video helpful,
please subscribe, press the like button, the notification button, and follow me on social media.